Hi, I wanted to give you a quick video update of what's going on in the world, what's going on in the economy, sort of the markets, and these markets are absolutely crazy. Everyone's wondering if we're going to have an October crash. And I will say that I think it's possible. Not looking for a 2007, 8 type of crash where the economy implodes at the same time, but this is one of the most dangerous markets I have seen in my 31 years in this business. The technical analysis is just falling apart. Technically, it looks terrible. What we're doing is building, and not to get too technical here, but we're building what's called a pennant pattern. We're getting lower highs and lower lows, and it's creating sort of a V pattern. And what typically happens is you break at the end of that V because it gets so narrow at some point. You break either to the upside or the downside. I feel like there's a greater chance that we will break to the downside. The good news is, I think that will be the capitulation. Capitulation is when people throw in the towel and say, I've had enough, I can't stand it anymore. I lost money in '07, I don't want to lose it again. I'm tired of this market going nowhere. And that typically is the bottom. So that will be the good news. And I'm not looking for 30, 40, 50% by any means. And I don't think the economy looks bad at all. In fact, fundamentally, it looks fairly strong. We have decent growth. GDP was 3.7% last quarter, which was pretty good, great, probably higher than it will be going forward. If we can get 2.5%, that's decent growth. Inflation is not on the horizon. There's a lot of scare right now about the Fed not raising or raising interest rates. Based on the economy, I do not think they should raise interest rates. I don't think the economy needs higher interest rates. We have no inflation, and you raise interest rates when you have inflation to fight inflation. There is no inflation. However, there's the inflection point. There's the belief that if the Fed doesn't get back to normal, get back to where they consider zero being before 2007, that they think that the economy must be worse than everybody else thinks, and there must be something that nobody else sees. So it's scaring investors, it's scaring the markets into believing that, hey, something must be worse on the horizon. So even though economically we don't need higher interest rates, emotionally and scientifically it might be better if they just raised them by a quarter of a point, just to show that, hey, we're back to normal. It's not great, but we're back to normal. And I think the market has a lot of anxiety about that. Once we put that behind us, and again, once they finally do it, it'll be behind us, and I think the market will breathe a sigh of relief. This pennant pattern I was talking about technically coincides almost identically with the fundamental pattern because the next Fed meeting is October 28th when they make another decision. The low in the market could coincide with that point. Again, not looking for massive moves. I'm not looking for a 50% decline, although if you get a panic, it could happen. So we're not looking to sell everything today, even though I think it's a good possibility it might go down, because I don't know for sure. I do have, as you know, much higher percentage of cash in the portfolio. We're not taking a lot of risk. We're not out there buying higher risk positions or adding to positions. If anything, we're preserving capital, raising capital where necessary. But you can't go all cash because you just don't know. So the idea for investment right now is, invest for need, not for greed. Be protected. We use asset lock as a protection for the portfolio. Be defensive here. I am a little nervous, and you haven't heard me talk about being nervous for a long time, but technically this market just doesn't look good. It's breaking down. Apple came out with new products, and their stock is still off 20% from their highs. A lot of risk in that stock, although it's a great stock, don't get me wrong, and I just got the brand new 6S today. It doesn't mean I don't like the company, but the stocks themselves are just not looking very strong. It just looks like we need sort of that blow off a reflection point, inflection point, and we've got to retest the lows. We made a low several weeks ago. The market went up from it. You typically need a retest, meaning the market has to go down to the level where it made that last low, and it needs to successfully bounce off that level. And that's what's called a successful retest. If it breaks through that level, well, then you have a new low, and you could have a bear market. I think it will successfully retest and bounce off and go higher. So the risk at this point is a little higher than the reward. You can't just go blindly all cash. You need to be tactically invested, which is what we're doing with selected sectors. I still like cybersecurity. In fact, the president in China, we're talking about that today. Biotech still looks good in healthcare, but you've got to be very, very careful for the next couple of months. It looks pretty dangerous. We're being as cautious as we can be. to get the best returns, but with the least risk possible. The economy does not look that bad. It looks like we have decent growth. Unemployment is low. There's enough growth, no inflation. I think once we get the nervousness of the Fed out of the way, then the market will start to digest the next quarter earnings, which start to come out in October, which I believe will be better than expected, which could lead to the next rally. Keep in mind, we are due for a recession. It's just time. We haven't had one for 7 or 8 years. Doesn't mean I'm anti-American or I think the economy is falling apart. It's just a natural cycle. So be very careful. Again, this is a dangerous market. You don't want to throw caution to the wind. You want to make sure that your money is being protected as best as possible. And do the planning. There's a three-legged stool we always talk about. Do the planning. Make sure you create a retirement income analysis and a retirement income stream you can't outlive. Make sure you're taking advantage of tax strategies in retirement. Make sure you're optimizing Social Security. Do your marginal tax distribution strategy so you have money in the different places. So when you need to do a sequence of distribution plan and take your money out to live on, you're in the lowest tax bracket and you remain in the lowest tax bracket now and for the rest of your life. And that's what a qualified retirement advisor can help you do. The second leg of the stool, of course, is the proper investment asset management, which is what we do every single day, watching the markets literally minute by minute, all the time, making sure, seeing if we need to make any adjustments. And the third leg is asset preservation, which is what we use Asset Lock for. So again, just approach it cautiously. Who knows if the market takes off and goes up from here? I hope I'm wrong, because I would rather give up 2 or 3% on the upside and know and feel more comfortable than to withstand a 20, 30, 40, or 50% decline on the downside. So make sure you're invested appropriately. Invest for need, not for greed. And if you need any help or have any questions whatsoever, feel free to give me a call. Always happy to talk. Thank you.